there, and welcome to today's 5 with Fitz. You know, there's a little bit of green on my screen this morning as I type or as I talk. Nothing spectacular, mind you, but I'll take it for as long as it lasts. Now, why would I say that? Simple, because the markets are forward-looking, and no matter how small the buying pressure is this morning, or it may be for now, it will ultimately blossom. Now, many investors think running away is the smarter move, and I get that a lot. But in reality, the biggest profits inevitably always go to those who lean into the fight. Now, it's not just me who says so. Our history is filled with this. Warren Buffett says, for example, the time to be greedy is when others are fearful. The late Sir John Templeton, who is widely regarded as one of the greatest stock pickers of all time and a mentor of mine, said, the best time to buy is at points of maximum pessimism. Now, my take is a little different, but along the same lines. Investing in optimism beats cowering in pessimism. Any day, every day. And the numbers bear that out. I mean, if you take a look at a chart since 1871, the markets have a very defined upward bias. And if you look back through the beginning of time, that's also very true. Innovation has always produced profits, and it's important that we remember that as investors. There may be bumps and speed bumps, but it's never, ever in recorded human history stopped. And that's worth thinking about. So here's today's playbook. Number 1, the dragon has bitten back. Now, overnight, country-specific tariffs on 86 U.S. trading partners went live, triggering President Trump's reciprocal tariff strategy, with rates ranging from 11% to 50%. China, of course, wasted no time retaliating, hiking duties on U.S. goods bound for Beijing from 34% to 84%. And now, with the latest wave in effect, Chinese exports to the U.S. face total tariffs as high as 104%. Now, the problem with this is that I've spent a lot of time in mainland China over the years. I think Washington is dangerously underestimating Beijing's resolve, in my humble opinion. Chinese President Xi's worldview is shaped by survival, loyalty to the state, and an almost fanatical commitment to national rejuvenation. The thing is, Xi doesn't view Western tariffs or sanctions as threats, but instead sees them as temporary obstacles, even necessary trials in China's long-term ascent. Now, this won't be a simple tit for tat. And the longer it takes to resolve, the higher the risk of irreversible or at least hard to reverse consequences for the U.S. economy, a view I share, by the way, with JPM CEO Jamie Dimon. Now, case in point, we're already seeing some of that play out. Delta has pulled its forecast, as did Walmart, which absolutely binned its quarterly operating forecast, citing tariffs. Still, and this is the important part, it is critical that we not lose sight of the fact that for the simple reason the markets move in cycles, not straight lines. Fear is temporary. Fundamentals are not. So while the headlines scream chaos and it's tempting to run for the hills, the truth is that volatility inevitably paves the way for the best opportunities if you've got the courage, the strategy, and the perspective to look beyond the noise. So I suggest keep your buy list handy. The sun is never as far away as it feels. Meanwhile, and if you're an OBAer, please check your email immediately for a special alert that I sent out late last night or early this morning, depending on where you are in the world, along with specific instructions and suggestions on a risk reduction move that I think makes sense at the moment. The income and stability we'll gain as part of the trade-off I'm suggesting is well worth your consideration, in my opinion. By the way, if you're not an OBAer and that sounds appealing, I'd like to toss my hat in the ring. Millions of investors tell me it's made a huge difference in the way they approach the market. You can find that at my website. Anyway, this is not an advertisement, but that's what I do for a living. So, talking tariffs to Apple and Tesla with the fabulous Liz Clayman. The super smart Liz Clayman invited me yesterday to talk tariffs, Apple, and Tesla as we launched the last hour of trading. Now, my take is that it's tempting to run for the hills, and I get why you might, but do so at your own risk. Apple has returned 534% over the past 10 years, and Tesla is 1,570%. Both of those companies still have a long way to go. The S&P, by comparison, clocked in at just over 139% over the same time frame. Now, history shows very clearly two things. A, that great companies occasionally get put on sale, and B, that is not your cue to run. It is your signal to lean in and add, using the right tactics, of course. Now, again, if you're talking about an attention span that's equivalent to that of a mosquito, fine, deal with the next 24 hours. You're a trader. You should be making money hand over fist with all this volatility. But if you're an investor, think in terms of days, weeks, months, and even decades, because the perspective is very different. Now, number 3, the crude awakening. Crude has dropped to the lowest level in 4 years as the U.S.-China trade war escalates. Now, with total tariffs on Chinese goods now hitting 104% and Beijing vowing to fight to the end, investors are bracing for what's called demand destruction, especially with China's being the world's largest oil importer. Now, translation in plain English, because I don't believe in $5 words, oil prices are dropping on recession fears because the fear is that if China slows, energy markets crack. Now, that was true for a long time and for much of my career, but these days I don't think so. Here's why. The backlash against all things EV is causing a resurgence in good old-fashioned piston clankers, which means the need for dinosaur juice accelerates. So here's a trade idea for you. If you look to the oil majors on pullbacks like the present, they tend to pay big fat dividends and they're engineered for volatility, so you get a smoother ride. And if you're bold, maybe consider a choice like UCO, the double long crude ETF, but only, and I mean only, if you've got a high risk tolerance, tight stops, and the discipline needed to work them. Remember, key piece of Fitz-wit here. When the herd panics, profits ride shotgun. And number 4, is Netflix the only tariff-proof stock out there? People ask me frequently if there's any such thing as a tariff-proof stock or a fund or some other investment. And the answer is no. But there are very definitely tariff-resistant ones out there. Netflix is a good example. Here's the quick version. 300 million plus subscribers as of the end of last year, which puts it ahead of Prime and Disney Plus. Multiple subscription tiers, with the ad tier, the least expensive one, generating 55% of signups because a lot of people have evidently decided that the annoyance is worth it. And long-form content like the NFL, which means that longer viewership, longer time on the screen, and you get it, more advertising bucks. Now, should you buy it? That obviously depends on your risk tolerance, objectives, and circumstances, none of which I know. But my take is that now is the time to double down on low beta, own it forever kind of quality with stable business models, excellent management, and rock solid cash flow. Now, true, these choices may come under pressure just like any other stock, but the smoother ride you get is worth it, at least to me anyway. All of these stocks, the kind of stuff I'm talking about, have fantastic upside potential when the storm passes. Now, Netflix, the jury's still out. It might just pop, and that's okay, but that's different. Hopefully you've got something similar in mind with your own portfolio, and if not, you know where to find me. And finally, number 5 today. AI is coming to a data center near you. Starting in Q3, Google is apparently going to let enterprises run its Gemini AI models inside their own data centers with no cloud required. Now, this is a big deal, not because it's Google and not because it's AI. It's a big deal because it's the first notable push that I've seen down into more localized AI computing. Now, a few years from now, that's going to be all the way down to your wristwatch or even your lawnmower, but let's not get ahead of ourselves. What you want to focus on here and now, and what's caught my attention, is that this is a major differentiator from rivals like OpenAI and Anthropic, both of which still require hosted access. I think it's potentially a game changer for privacy-sensitive clients. Think governments, healthcare, defense here. Google, the problem is, has radically underperformed peers for a long time, and heck, the S&P 500 too. So it might be worth a look. It's a big in my book. Today's bottom line, I don't mean to make light of all the selling or the fear that inevitably creeps in around the edges whenever Wall Street gets in a foul mood. What's happening now is seriously, and for that matter, seriously scary. Just understand this. Any fear that you're feeling is a catalyst for growth, knowledge, and yes, even profits. Contrary to what many people want to think, it's not something to be exploited at your expense, but an emotional input you can learn to recognize, overcome, and even use to your advantage. It doesn't matter whether you're a trader or an investor. The principles are absolutely the same. All roads lead somewhere, so take the walk and enjoy it. By the way, Bryce, our 60-pound fur missile, will lead the way. And hopefully you can see this picture if you've read the 5 with Fitz, because I can't display it on the screen. As always, let's make it a great day. You got this, I promise, and I will see you tomorrow.